Hello friends, welcome back. In this session, we are going to learn about annual report. Before we move ahead, let us understand what is an annual report. An annual report is a detailed report card of the company for the preceding year. It is issued by the company for the various stakeholders to understand the company's performance in the preceding years, its future and its intention to present this data. In addition, it includes the auditor's review towards the financial statement of the company. Technically, it is a detailed report card about the financial and non-financial aspects of the company, which is issued by the company for the benefit of the stakeholders. What are the components of the annual report? The annual report consists of these 6 types of information. Of these, points numbers 1, 4, 5 and 6 are mandatory in most countries. However, 2 and 3 are not applicable in all jurisdictions. This is important. The countries having the annual report of a company are sometimes guided by the regulators of that particular country. Furthermore, different countries have different regulations for the annual report. For instance, Singapore may have a set of regulations which may be different than those of the United States and Japan. Now, let us understand what a chairman's statement is. I will explain this concept in detail. However, for the time being, let me give a brief description about it. A chairman's statement includes the statement given by the chairman about his review. What is a review operation? A review operation is a section in which the management gives a review of the company's performance, operations, difficulties, challenges, and opportunities. The statement of directors' responsibility includes the statement of the directors about the complete performance of the company. It gives assurance that there are no issues or problems within the company. In addition, if there are any issues, it specifies what the issues are. Then, there is the auditor's report, where the auditor of the company presents a report reporting that the audit team has checked all the accounts and that the company's account reflects true and fair statements without any issues in the financial statement. Then, there is financial statement. What is a financial statement? We will discuss about the financial statement later. However, it includes the income statement, balance sheet and cash flow. Finally, notes to the account. These support the company's accounts by clarifying various aspects about the company's accounts in terms of depreciation, accounting policy, tax issues, debt, interests and security. All this information is available in the notes to the account. We will learn about these concepts in detail in the slides that follow. We have explained this with the help of the Coca-Cola Hellenic Bottling Company. Let us start with the chairman's statement. A chairman's statement is basically addressed to the shareholders. It is very important because the chairman expresses his views in the statement to the shareholders. Technically, it is generally positive and conveys more about the future prospects of the business and how the company intends to achieve these prospects. Apart from the positive aspects, it also discusses regarding the challenges in a positive way. It also has a brief overview of the company's performance and talks about new product launches, the revenue generation, profitability and product discontinuation. The chairman's statement is not subjected to audit. These are the 4 points which are meant to give an outlook about the company's operations and performance to the shareholders. It is not checked by the auditors and is finally signed off by the chairman of the company. Let us understand what is the review of operations. As said earlier, the review of operations is not mandatory. However, it is voluntary in some countries and mandatory in the others. What does it include? It includes the operating and financial overview. The operating overview gives an idea about how the company operates or wants to operate in the business. The financial review gives an idea about the financial transactions of a company in terms of revenue, cost or operations. Again, we are talking about the Coca-Cola Company. It has a market review, talking about the market and the GDP numbers. We are discussing how the company is improving its small business in terms of drink segment and how the consumers are shopping. It indicates that 21% of the consumers take small bottles and 79% of them take big bottles. It helps to predict the consumer behaviour and the value created in terms of profit, which is around €280 million. The value created includes the reduction, employment, water, volunteer hours and taxation. It also includes the values of the company, created for the shareholders, suppliers, employees, customers and communities. Therefore, the market review covers everything, which helps the shareholders to understand about the direction in which the company is going and how it is going. Then there is the director's responsibility. The director's responsibility is to ensure that there is an accurate account keeping and that there is no discrepancy or misrepresentation. The director states that everything is fine and there is no issue with the company's accounts, which is ensured through the appropriate checks. This is the statement of director's responsibility and is given by the CEO of the company. These are the quick details of the Coca-Cola Company. The next one is the most important and is the auditor's report. The auditor's report basically gives a true and fair view of the accounts and confirms that all the company accounts have been checked and that they are true and fair. An important point that I want to highlight is that even though the auditors say true and fair view, the auditors do not check each and every item of the company, and they perform the checks based on this test check. The term true and fair view indicates that the auditors have checked the company records based on their sampling procedures or internal processes and have not come across any discrepancies, mistakes or misrepresentations in the company's records. It is fair that the auditors believe that the company has disclosed all facts materialistically. As said earlier, it is believed that the company has disclosed all the transactions and the auditors have not come across any misrepresentation, fraud or mistake in the accounts of the company. In other words, the auditor's report confirms that the accounts have been complied as per the accounting standards of the company. The following are the three assertions that the auditor's report makes. A true and fair view of accounts. No mistakes, misrepresentation or fraud in the company and the preparation of the company accounts, as per the accounting standards. Finally, the report is signed by the auditors. Next is the auditor's opinion. The auditors give two kinds of reports, namely qualified and unqualified. What is a qualified report? A qualified report is one in which the auditors find that there is some deviation in the accounting principles and the company gives a reason for the deviation. Basically, if the auditor gives the qualified information, it means that there are some issues in the report. Qualified report means that there is some issue or deviation in the company and the auditors have given the report subject to the issues or deviation. They will state that everything is fine except that the company has not paid the tax on time, or the company has intentionally defaulted, or the company has intentionally not followed the standard accounting policies while recording depreciation. This is called a qualified report. Unqualified report means that it is a clean report and there is no qualification that the company and the auditor feel that the information provided is true and fair, and there is no material omission or misrepresentation. An adverse report is not good and is not seen as a positive sign. It is seen as a negative report by the stakeholders. What is the meaning of a negative report? It means that the company accounts have not been fairly presented and there are many mistakes, misrepresentations, omissions and frauds. When you get this kind of report, please do not rely on it. At such a juncture, it is a red flag for you to understand why it is an adverse report. Make decisions accordingly and find the disclaimer. A disclaimer is where the auditors are not able to express their opinion. It means that the auditors cannot say whether the company is right or wrong, whether there is a fraud or not, or whether there is a mistake or not. This could be because the auditors either do not have much information, they do not have access to most of the information, or information provided is not sufficient for making decisions. These are the 4 different kinds of reports that an auditor can give based on which we should make decisions. Of course, this is the best and the worst. The qualified disclaimer is in the middle of the two, which should be reviewed to how they have awarded the report. Why are financial statements audited? It is very simple. Financial statements are audited to have an independent review of the company accounts. As stakeholders, we cannot check the company's financial statement. We rely on a third party or independent party, such as the auditors, to review the accounts. That is why we want our financial statement audited by some independent organisation or people, so that we can rely on that particular financial statement. The process is very simple. We hire the auditors, who can be from reputed firms such as E&Y, PwC, KPMG or Deloitte. These are the 4 major audit firms. However, there are many more reputed firms such as BDO and Grant Thornton. There are various kinds of auditors who can review the accounts, get into entire statements and account entries, process and reporting, and give an opinion whether a company is good or not. If it is not good, what needs to be done, and what are the views about that financial statement? Generally, all these are conducted by independent certified public accounting firms and the 4 major audit firms. However, there are many other audit firms in the market. Finally, financial statement. What is a financial statement? As said earlier, a financial statement generally consists of the following 3 components, namely the income statement, the balance sheet, and the cash flow. These are the 3 most important financial statement components, which we are going to learn in the next session. Finally, the notes of accounts. What are the notes of accounts? The notes of accounts basically help in understanding the accounts. They provide further details into the items of the financial statement and consist of various references of the column. These notes reference the various items in the financial statement and give more information. For example, if you have a loan, what are the interest rates? What is the security you have taken? And what are the broad terms? Similarly, let us say it is related to a bank transaction. Who are the parties involved? What is their information? Let us consider depreciation. What are the different types of depreciation used? Whether it is good or not, and whether there is a change in the depreciation policies. The notes to account help in understanding the accounts better. They are like your additional notes, which help you to understand the concept. These notes help you to understand a financial statement, and also disclose how the concept is prepared and the various accounting policies. Again, from the Coca-Cola Company perspective, we first understand what is the basis of the accounting policy, the preparation and the consolidation. These are just limited. However, there are many more in this financial statement. This is what we have in the financial statement and in the accounts. In accounts, we will learn in great detail about the income statement, balance sheet and cash flow in the future videos. I hope you've enjoyed this session. In case you have any questions, queries or doubts, feel free to send us an email and connect with us. Thank you friends, and have a nice day.